If you don't understand multifamily language, you don't lose deals because you're unlucky. You lose them because you don't hear the warning signs while they're happening and get pushed into bad deals that you never should have touched. This is the part that no one tells you. In multifamily, no one stops the conversation to make sure that you are keeping up. Brokers don't slow down. Lenders don't translate, operators don't pause to define terms. They assume fluency. And if you just nod along without it, you're not learning, you're just volunteering to be the least informed person in the room. And that's how bad deals get sold. Not with lies, but with language. You hear words like NOI, cap rate, DSCR, IRR tossed around like a casual small talk. Everyone else sounds very confident, and you start wondering if you missed a class. The quiet little voice shows up, maybe I'm not ready for this yet, but here's the truth. You are closer than you think. And this isn't some secret society, it's just a system. And once you understand the language, you stop being impressed and start being dangerous. So let's decode it. Not like a textbook, but like an operator. And yes, click like and subscribe, not because the algorithm needs it, but because if you're serious about this game, if you want fluency and not motivation. Everything in multifamily starts with one number, 1. If you don't understand this number, nothing else really matters. NOI, or net operating income. This is the heartbeat of the property. Not cash flow, not profit, not vibes, NOI. It's the income that the property produces before debt, before taxes, and before you touch it. For example, 4 units, total rent $6,000 a month or $72,000 a year. Expenses, you have maintenance, utilities, insurance, management. Let's say it's $24,000. What's left is $48,000, and that $48,000 is your NOI. And the reason everyone is obsessed over NOI is simple. NOI is what the market prices, not your mortgage, not your down payment, not your story, which leads us directly to the cap rate, one of the most misunderstood terms in real estate. Cap rate is not a return. It is not a prediction. It is a pricing language. Cap rate is NOI divided by value. So if you take the same 48,000 NOI on a, let's say, 800,000 building, it's a 6% cap rate, which is 48 divided by 800. Lower cap rates mean investors are willing to pay more for the same income, and higher cap rates mean they demand a discount. So when you look at New York at a 4% cap, it's expensive. Midwest at 8% cap is cheaper, and usually for a reason. Here's the insider inside the beginner's miss. Cap rates move. When markets heat up, cap rates compress, they go down, and values rise even if rents don't. And when markets cool, on the opposite side, cap rates expand and values fall even if the building performs. This is why buying at higher cap rates in the right markets gives you a margin for appreciation. Now, let's talk about the term the beginners cling to emotionally. Cash on cash return. Cash on cash is your annual cash flow divided by the cash you invested. So if you put in $160,000 down with $40,000 in closing costs and repairs, totaling $200,000, and if the property nets $20,000 a year after debt and expenses, that's 10% cash on cash. It's solid, it's respectable, but here's the mind shift. Cash on cash doesn't make you wealthy. It just keeps you solvent. When rates rise or expenses spike, that passive income can turn into a stress test. Cash flow just keeps you alive. Equity, though, changes your life, which brings us to DSCR, debt service coverage ratio. The number that lenders care about more than anything else, because DSCR is NOI divided by annual debt payments. So same 48,000 NOI divided by 32,000 in mortgage payments is a 1.5 DSCR. Lenders usually want at least 1.25 DSCR. Why? Because DSCR is your margin of error. If rents dip, expenses rise, or vacancy increases, that ratio shrinks. Ignore DSCR and you're just one bad month or quarter away from panic. Now we're gonna zoom out to the metric that shows the entire picture, IRR, which is internal rate of return. IRR factors in cash flow, timing, and exit. Same deal, $200,000 invested, 20 grand a year in cash flow. Let's say we sell in 5 years. At a 5% cap, the value might be around $960,000 and IRR around 18%. But if cap rates rise and you sell at a 6 cap, the value now drops to $800,000 and IRR collapses to 8%. It's same property, you put in the same effort, but completely different outcomes. IRR exposes the risks that simple returns hide. And then there is value add, which is buying underperforming properties and fixing up operations, maybe not just even cosmetics. Below market rates, you have bad management, deferred maintenance. You go in, you renovate, you raise rents 15%. The NOI now jumps from 48 grand to 55. At a 5% cap, value jumps to now 1 million. You didn't wait for appreciation, you literally forced it. That's value add, but when done wrong, it destroys value just as fast as it brings it up. And this is where property classes matter. Class A, you have Class A, Class B, Class C, and so on and so forth. Class A is your new, shiny, low risk, low cap rate building. Class B is more stable, it's functional with a little room to improve. Class C might be a little rough. It's higher yield, but also higher headaches. Most first-time investors belong in the B class area. It's a balanced risk with real upside. Buy the wrong class and your great deal suddenly becomes an unpaid therapy. Now, the documents that save you from overpaying, it's the rent roll and the T12. The rent roll shows what should be happening, and the T12 shows what actually happened. So if the rent roll says $6,000 a month, but the T12 averages $5,200, well, that gap is either delinquencies, vacancies, or fiction. The gap is where bad deals hide. And finally, LTV, loan to value. A 75% LTV means the bank loans you $600,000 on a $800,000 property. Leverage amplifies wins, but it also amplifies pain. High leverage feels powerful on the way up and very merciless on the way down. That's why language matters. Higher LTVs are more expensive, meaning you pay more in interest rate, versus lower leverage is usually cheaper. So, multifamily terms aren't some jargon. They're signals. They tell you when to lean in, when to pause, and when to walk away quietly while someone else smiles and overpays. Real pros, they don't memorize terms. They listen to them. Keep waiting until you feel experienced, or you can start speaking the language today and stop being the slowest person in the room. So comment decoded if this just clicked for you, and send this to a friend who keeps saying, I'm not ready yet, because ready isn't a feeling, it's a fluency. And in the next episode, I'll show you how to use this very language to spot deals that investors will fight over before they even hit the market.